Listen, I want you to picture a very specific Tuesday morning, not a hospital, not a courtroom, a kitchen in a split-level house in Akron, Ohio, the kind of kitchen with a corkboard on the wall where grocery lists go to die, the kind of kitchen where the same coffee maker has been sitting on the same counter since 2009. The man sitting at that table is Gerald. He is 72 years old. He spent 31 years as a logistics coordinator for a regional manufacturing company. He kept a paper calendar on his desk until 2019 because he did not trust the cloud with his deadlines. He is the kind of man who reads the terms and conditions, the kind of man who calls the insurance company back when the bill does not match the explanation of benefits. The kind of man who, at 58, sat down with a yellow legal pad and mapped out every year of his retirement on paper before his financial advisor even knew he was thinking about it. Gerald retired at 66. He planned it carefully. He delayed Social Security until 68 to collect a larger monthly check. He kept his traditional IRA untouched because he had been told correctly that the money grows tax deferred and that patience was the smartest move. He lives modestly. He does not take vacations that require a passport. He drives a 2014 Ford Escape that he maintains himself. Gerald turns 73 in 4 months. Gerald has no idea what is about to happen to him. His financial picture looks like this. A traditional IRA rolled over from his company $401,000 with a current balance of $810,000. A Social Security benefit of $2,950 per month, which is $35,400 per year. A small pension from his former employer paying $725 per month. A savings account at the local credit union generating $3,100 per year in interest. A taxable brokerage at Vanguard with $95,000 in index funds generating roughly $2,800 per year in qualified dividends. On paper, Gerald is fine, more than fine. He is the man who did the work, ran the numbers, and arrived at 72 with $810,000 in a tax-deferred account he has never touched and a Social Security check that arrives every month without drama. What Gerald does not know is that in 4 months, when he turns 73, the IRS will require him to begin pulling money out of that IRA whether he wants to or not. What Gerald does not know is that the first forced withdrawal will not just add income to his tax return, it will set off a chain reaction across 3 separate federal systems simultaneously. What Gerald does not know is that a single required minimum distribution, one withdrawal he never chose to take, will push him into a higher tax bracket, trigger an 85% Social Security taxation rate, and spike his Medicare premium by hundreds of dollars per month, all in the same tax year, all from the same account, all from one number on one line of one form. What Gerald does not know, and what I am going to show you in the next 30 minutes, is the math, the full math, not a summary, not a general warning, the actual calculation, step by step, dollar by dollar, so that you can see exactly what is happening and exactly what can still be done before the first RMD fires. Before we go further, let me be precise about what this video is and what it is not. This is not a video about whether you should take money out of your IRA early. This is not a debate about Roth versus traditional. This is a video about one specific mechanism, the required minimum distribution at age 73, and the 3-system chain reaction it triggers when it lands on top of an active Social Security benefit and a standard portfolio of interest and dividend income, because most people walking into age 73 with a traditional IRA have no idea that the RMD does not just add income. It multiplies damage across 3 separate federal systems at the same time. Smash the like button right now. I am not asking as a courtesy. The 2026 YouTube algorithm has a documented pattern of reducing the reach of videos that explain what the IRS actually does with retirement income. Every like on this video pushes it into the feed of one more Gerald, sitting at one more kitchen table 4 months away from a chain reaction he cannot see coming. Subscribe and flip the bell because the archive I am building here is the manual your financial advisor was supposed to hand you the day you rolled your $401,000 into that IRA. Now let me show you the chain reaction, because this is not one problem. It is 3 problems that fire in sequence from a single trigger, and the reason most retirees never see it coming is that most financial advisors only explain the first one. Almost none of them volunteer to show you the second. And the third one is the one that keeps extracting money for 2 full years after the income event that caused it. The trigger is the RMD. The RMD stands for Required Minimum Distribution. It is the amount the IRS forces you to withdraw from your traditional IRA every year beginning at age 73. The amount is calculated by dividing your IRA balance by a life expectancy factor published in the IRS Uniform Lifetime Table. For a 73-year-old, that divisor is approximately 26.5. Gerald's IRA balance at 73, assuming conservative 4% annual growth from his current $810,000, will be approximately $891,000. His first RMD is $891,000 divided by 26.5. That is $33,622. Gerald did not choose to take $33,622 out of his IRA. The IRS chose it for him, and the moment that money moves, three systems activate. System 1 is his federal income tax bracket. System 2 is his Social Security taxation rate. System 3 is his Medicare Part B premium. Let me show you each one. Gerald's baseline. Income before the RMD looks like this. Social Security at $35,400 per year. Pension at $8,700 per year. Credit union interest at $3,100 per year. Vanguard dividends at $2,800 per year. Total non-RMD income is $50,000 per year. Now the RMD lands, Gerald's total gross income jumps to $83,622. That number is going to do three things at once. Problem 1, the bracket, as a single filer in 2026. The 22% federal bracket begins at approximately $47,150 of taxable income after the standard deduction for seniors. Gerald's standard deduction as a single filer over 65 is approximately $16,550. His taxable income before the RMD after deductions sits at roughly $33,450. He is comfortably inside the 12% bracket. The RMD adds $33,622 of ordinary income. His taxable income after the RMD and after deductions jumps to approximately $67,072. He has crossed into the 22% bracket, not because he chose to spend more, not because he had a windfall, because the IRS forced a withdrawal from an account he was perfectly happy leaving alone. Problem 2, the Social Security taxation rate. This is where the damage multiplies. The IRS calculates what percentage of your Social Security benefit is taxable using a formula called the provisional income threshold. Provisional income is your adjusted gross income plus any tax-exempt interest plus 50% of your annual Social Security benefit. Before the RMD, Gerald's provisional income looks like this. Non-Social Security income of $14,600, which is the pension plus the interest plus the dividends, add 50% of his Social Security, which is 50% of $35,400, equaling $17,700. Gerald's provisional income before the RMD is $32,300. He is just below the $34,000 threshold at which 85% of Social Security becomes fully taxable for a single filer. The RMD adds $33,622 to his adjusted gross income. His provisional income after the RMD is $65,922. He has blown past the $34,000 threshold by more than $31,000. The IRS now includes 85% of his Social Security benefit as ordinary taxable income. 85% of $35,400 is $30,090. That $30,090 gets added to his taxable income on top of the RMD itself, on top of the pension, on top of the interest and dividends. Here is what that means in practice. The $33,622 RMD did not just add $33,622 of income. It also dragged $30,090 of Social Security income into taxable territory that was previously sheltered. Gerald's effective income addition from a single $33,622 withdrawal is $63,712. He paid taxes on $63,712 of income from a $33,622 distribution, that is the tax torpedo. Every dollar of RMD income generated $1.89 of taxable income. At the 22% bracket, Gerald is not paying 22 cents on each RMD dollar. He is paying closer to 40 cents. Stop the video right now and go to the comments. Tell me one thing. Have you or has anyone in your family ever calculated what happens to your Social Security taxation rate the year your RMD begins? Not after the first tax bill arrived, before. I am going to be honest with you. Based on what I see in this channel's comment section, fewer than 1 in 15 people watching this video have run that calculation. Not because they are not careful, because nobody told them to. Tell me your age, your IRA balance, and whether your RUMs have already started or whether you are still in the window before 73. Drop it in the comments right now. I read every single one. Problem 3. The Medicare premium spike. This is the trap that fires last and hurts longest. Medicare Part B premiums are not fixed for all retirees. The federal government charges higher premiums to retirees whose income exceeds certain thresholds. This surcharge is called IRMAA, the Income-Related Monthly Adjustment Amount. And the way it is calculated contains a feature that makes it uniquely brutal for retirees experiencing their first RMD year. The Medicare premium you pay in any given year is not based on your current income. It is based on your income from 2 years earlier. Your 2029 Medicare premium is set by your 2027 tax return. Your 2030 premium is set by your 2028 return. Gerald turns 73 in 2027. His first RMD fires in 2027. His modified adjusted gross income in 2027, after the RMD and the full Social Security inclusion, is approximately $83,622. As a single filer in 2027, the first IRMAA tier begins at $106,000 of Magi. Gerald is below that threshold. But here is what changes Gerald's situation going forward. The RMD does not stay at $33,622. It grows every year because the divisor in the uniform lifetime table decreases as he ages, and his IRA balance, even with withdrawals, continues to grow in years when markets perform. By age 75, Gerald's IRA balance, assuming modest growth after distributions, will be approximately $870,000. His divisor at 75 drops to approximately 24.6. His RMD at 75 is $35,365. By age 77, the RMD approaches $38,000. By age 80, if the account has grown even modestly, the annual forced withdrawal can exceed $42,000. At $42,000 of RMD income added to Gerald's baseline income of $50,000, his Magi crosses $92,000. Add the full 85% Social Security inclusion triggered by the provisional income calculation and his Magi pushes past $106,000. The first IRMAA tier activates. His Medicare Part B premium jumps from the standard $185 per month to $259 per month. That is $74 extra per month, $888 extra per year. And because of the 2-year look back, Gerald will not feel that premium increase until January after the income year that caused it. He will not connect the cause to the effect. He will see his Medicare statement in January and wonder why his premium went up, and his financial advisor will not volunteer the explanation because it requires acknowledging that nobody warned Gerald about the RMD domino effect when he was 68 and still had years to restructure. 3 problems, 1 trigger. The RMD at 73 pushed Gerald into a higher bracket. The same RMD activated the full 85% Social Security taxation rate. The growing RMD in his late 70s will push his Magi above the IRMAA threshold and spike his Medicare premium for 2 years at a time with a built-in delay that breaks the cause and effect chain. Save this video right now. Hit the bookmark. Whatever your platform calls the private archive function, use it. Because what I am about to walk through is the 3-step restructuring sequence that Gerald needed to start at age 68 and that you may still have time to begin if you are watching this before your first RMD fires. This is the playbook. Step 1. The Roth conversion ladder before 73. The traditional IRA is the engine that powers all 3 problems at the same time. It feeds the bracket jump, it fuels the tax torpedo, it loads the IRMAA tripwire, and the only way to reduce the damage is to shrink it before the RUMs begin by converting portions of it to Roth each year during the low-income window between retirement and age 73. Gerald retired at 66. He delayed Social Security until 68. Between age 66 and 68, his taxable income was approximately $11,500 per year from savings, interest, and dividends alone. No pension had started yet. No Social Security. As a single filer in 2026, the top of the 12% bracket after the standard deduction sits at approximately $58,825 of taxable income. Gerald had nearly $47,000 of unused 12% bracket space every year for 2 years. He converted nothing. Between age 68 and 73, after Social Security started and the pension came online, his taxable income rose, but the 12% bracket space narrowed rather than disappeared. In years 68 through 72, he still had approximately $15,000 to $22,000 of conversion space available at 12% or lower each year. If Gerald had converted $40,000 per year from age 68 to 72, 5 years of conversions, he would have moved $200,000 of pre-tax IRA money into a Roth account. His conversion tax cost at an average effective rate of 14% would have been approximately $28,000 over 5 years. His traditional IRA balance entering age 73 would have been approximately $691,000 instead of $891,000. His first RMD would have been $691,000 divided by 26.5, equaling $26,075 instead of $33,622. That $7,500 reduction in RMD income is the difference between staying below the 85% Social Security inclusion threshold and crossing it. The tax torpedo does not detonate, the bracket stays at 12%. The IRMAA threshold is not approached for several additional years. And the $200,000 sitting in the Roth IRA generates 0 taxable income, 0 provisional income impact, and 0 IRMAA exposure for the rest of Gerald's life. The Roth conversion window is the years between your retirement date and your 73rd birthday. If you are inside that window right now, you have an opportunity that is closing in real time. Every year you wait is another year of 12% conversion space you will never recover. Step 2. Restructuring the interest income. Gerald's credit union savings account generating $3,100 per year in ordinary interest is a passive contributor to his provisional income problem. Every dollar of CD or savings interest flows directly into adjusted gross income and directly into the provisional income formula. It is not the villain in the story, it is a quiet accomplice. The fix is not to eliminate the savings, it is to change the form of the income. Two tools accomplish this without sacrificing safety or liquidity. First, high-quality municipal bonds from Gerald's state of Ohio. Interest on in-state municipal bonds is exempt from federal income tax and from Ohio state income tax. A AA-rated Ohio-issued municipal bond in 2026 yields approximately 3.6%. That sounds lower than the 4.1% his credit union is paying. But because the municipal bond interest does not appear in his adjusted gross income and does not feed the provisional income formula, the tax equivalent yield when accounting for the Social Security torpedo effect is closer to 5.3%. He earns more in real terms while removing the interest income from the damage zone entirely. Second, a multi-year guaranteed annuity, which financial professionals call IRMAA. IRMAA is a fixed annuity contract that earns a guaranteed interest rate inside a tax-deferred wrapper. The interest compounds annually inside the contract and does not appear on a 1099 until withdrawal. If Gerald parks $40,000 of his savings into a 5-year MIGA earning 4.8%, the $1,920 of annual interest that money generates does not touch his adjusted gross income, does not touch his provisional income, and does not contribute to the IRMAA calculation for 5 years. He chooses when to take the income, which means he can time the withdrawal for a deliberately low-income year after a smaller RMD or after a Roth conversion has created tax room. The deferred income becomes a tool instead of a liability. Step 3. Repositioning the brokerage account. The $2,800 Gerald receives annually in qualified dividends from his Vanguard brokerage account is the subtlest piece of the problem. Qualified dividends are taxed at preferential long-term capital gains rates, 0% or 15% for most retirees. So the dividend income itself is not the primary issue. The issue is that those dividends still count as income inside the provisional income formula and still push his Social Security taxation rate toward the 85% threshold. The restructuring here is about asset location rather than asset elimination. Gerald does not need to sell his index funds. He needs to hold his most dividend-heavy positions inside his Roth IRA, where the dividends generate zero taxable income, and hold the lowest dividend, highest growth assets inside the taxable brokerage. Growth-oriented ETFs and tax-managed funds that minimize annual dividend distributions are designed specifically for taxable accounts held by retirees in this situation. A simple reallocation of this kind can reduce Gerald's brokerage dividend income from $2,800 to approximately $400 to $900 annually. No sale required. No capital gains event triggered. One phone call to the brokerage to execute a fund swap within the same account. That reduction alone, combined with the municipal bond restructuring of his savings income, can drop Gerald's provisional income by $4,500 to $5,500 per year, which in his specific situation is the difference between 50% Social Security inclusion and 85% inclusion on a $35,400 annual benefit. At 50% inclusion versus 85% inclusion, $12,390 of Social Security income disappears from his taxable income each year. At the 22% bracket, that is $2,725 per year in federal tax savings from a fund reallocation decision that cost him nothing and took one afternoon. Now let me show you the full contrast. Because abstract numbers do not stick, real people do. Gerald and George, same age, same city, same company, same retirement date, same IRA balance of $810,000, same Social Security benefit of $35,400, same pension of $8,700, same credit union interest of $3,100, same Vanguard dividends of $2,800. Gerald did nothing between 66 and 73. He watched the IRA grow, he enjoyed the tax deferral, he filed every year with a clean return. He never ran the RMD projection forward, he never calculated what the provisional income formula would look like the year the distribution started. At 73, Gerald's first RMD is $33,622. His provisional income crosses the $34,000 single filer threshold for 85% Social Security inclusion. His taxable income after deductions jumps to approximately $67,000. He moves into the 22% bracket. His effective marginal rate on each RMD dollar is approximately 40 cents due to the torpedo effect. His federal tax bill at 73 is approximately $9,400. Not catastrophic in year one, but the RMD grows each year. By 78, his annual tax burden from the combined RMD and Social Security inclusion reaches approximately $12,800 per year. By the time his Magi crosses the IRMAA threshold in his late 70s, his Medicare premium adds another $888 to $2,112 per year depending on which tier he hits. He lives to 85. His total federal tax and Medicare premium extraction from age 73 to 85 is approximately $148,000. George did the work. At 67, George sat down with a tax professional who showed him the RMD projection. The advisor ran the provisional income calculation forward to age 73 and showed George exactly where the torpedo would detonate if he did nothing. George converted $40,000 per year from his traditional IRA to Roth between ages 68 and 72. He paid approximately $28,000 in total conversion taxes over 5 years. His traditional IRA at 73 is $691,000. His first RMD is $26,075. His provisional income with the smaller RMD stays below the 85% inclusion threshold. His taxable income after deductions sits at approximately $51,000. He remains in the 12% bracket. His federal tax bill at 73 is approximately $4,200. The torpedo never fires. The IRMAA threshold is not crossed until age 81 at the earliest and at a lower tier than Gerald reaches. His total federal tax and Medicare premium extraction from age 73 to 85 is approximately $72,000. Add George's conversion cost of $28,000. His all-in lifetime tax cost is approximately $100,000. Gerald's lifetime tax cost from age 73 to 85 is approximately $148,000. George's all-in cost, including the conversion taxes he paid up front, is approximately $100,000. George saved $48,000 in federal taxes and Medicare premiums. On top of that, the $200,000 Roth IRA George built during the conversion years grew completely tax-free and will pass to his children without a single dollar of income tax owed on the inherited balance. Gerald's remaining traditional IRA will be inherited by his children and taxed as ordinary income under the Secure Act 10-year rule. The difference between Gerald and George is not intelligence. It is not income, it is not discipline, it is one conversation that happened for George at 67 and never happened for Gerald at all. The window is open right now. If you are watching this before your 73rd birthday and before your first RMD fires, here is what I want you to do this week. Pull your most recent IRA statement and write down the current balance. Go to the IRS Uniform Lifetime Table, which is available on irs.gov in Publication 590B, and find the divisor for your current age. Divide your balance by that divisor. That number is your projected first RMD. Now take that number and add it to your current annual income from Social Security, pension, interest, and dividends. Run the provisional income calculation. Take your non-Social Security income, add 50% of your annual Social Security benefit, and see where that total lands relative to the $34,000 single filer threshold or the $44,000 married filing jointly threshold. If your provisional income with the RMD added crosses those thresholds, the torpedo is on course. You now know, and knowing before the first distribution is the only position from which you can still do something about it. The Roth conversion window closes at 73 when the RUMs begin, and conversion math gets complicated by the mandatory distribution requirement. The interest income restructuring can happen at any age, but the earlier you do it, the more provisional income damage you avoid. The brokerage reallocation has no deadline, but every year you delay is another year of unnecessary Social Security taxation. The IRS is not going to call you. Your bank is not going to suggest you move your savings into municipal bonds because your savings account is their product. Your brokerage is not going to recommend the low dividend fund swap because the dividend-heavy fund generates more transaction activity. Your financial advisor may not volunteer the RMD projection because it requires admitting that the traditional IRA, the account they helped you build for 30 years, has a built-in extraction mechanism that fires at 73 and runs until the account is empty or you are gone. The information has always been in IRS Publication 590B and in the Social Security Administration's own benefit calculation worksheets. The provisional income formula is in the instructions to Form 1040. The IRMAA table is published by the Centers for Medicare and Medicaid Services every year. None of it is hidden, all of it is buried. And none of the people who profit from selling you retirement products have a financial incentive to translate the buried language into plain arithmetic and put it in front of you before the first RMD fires. That is not incompetence. That is the structure of an industry that earns fees from assets under management and not from the tax outcome of the people those assets belong to. Gerald is still at the kitchen table in Akron. The coffee is cold. The corkboard is still there. The 2014 Ford Escape is in the driveway. He turns 73 in 4 months and the RMD Domino is standing upright, fully loaded, pointing at his bracket, his Social Security taxation rate and his Medicare premium at the same time. He does not know it is there. You do now. Like this video, subscribe, and flip the notification bell so you get every video in this archive the moment it goes live. Drop your situation in the comments right now. Tell me your age, your traditional IRA balance, whether your RUMs have started or whether you are still in the window, and whether you have ever run the provisional income calculation forward to see where the torpedo lands. I read every comment. The comment section is the place where people who still have time find out, they still have time, and people who have already crossed 73 find out what they can still do from here. Share this video today with one person who is between 68 and 72 and has a traditional IRA they have not touched. One person who thinks the tax deferral is working in their favor and has never modeled what the REM does to the three federal systems it triggers simultaneously. The domino is standing, the window to reposition is open, the math is not subtle, and the IRS is not in a hurry because the IRS does not need to be. The forced distribution fires automatically at 73 and the three-system chain reaction runs on its own from there. Do not let it.